Welcome to Objective 5 in Unit 4 of Accounting 3310 on capital leases. Capital leases are an economic combination of a purchase of an asset and its financing. Although the legal contract has the lessor retain the title, the lessee has all of the other rights and responsibilities of ownership. Thus, the accounting for capital leases is very different from the accounting for operating leases. Brush up on your time value of money skills. We'll combine accounting for equal payment notes with accounting for long-term assets. How do capital leases appear in financial statements? Students will be able to understand the use of assets through capital lease contracts at the end of this objective. Capital leases are used by companies to acquire assets for use in the business with the following advantages over a direct purchase. Capital leases can provide 100% financing at fixed rates. It often provides a lower financing cost than an unsecured borrowing. It can have tax advantages, and there may be flexibility of debt provisions available in a lease that are not available in a direct borrowing. Here's the same span of leasing that we've looked at before. We called the items that were down on the rental side operating leases, and we're going to call the items over on the owning side capital leases. Somewhere in the middle, the criteria of the Financial Accounting Standards Board break up lease contracts into those two categories. Here again is our definition for operating versus capital lease. The capital lease is a lease that transfers the rights and responsibilities of ownership of an asset from the title holder to the user of the asset. The lessee has the use of the asset but not the title to it. So the formal legal form is still a lease, but the economic essence is that they've purchased an asset and financed it. Leases can be complex contracts, and we need to know some of the terms that are used in contracts so that we can talk about valuing a capital leased asset. First, executory costs are the normal operating costs that can be conveniently included in lease payments but are actually associated with operating expenses and are not included as part of a capital lease obligation or the value of the leased asset. So if we have a lease in which the lessee pays for maintenance or pays for taxes, those items might be bundled in with the rental payment, but we're going to take them out and use just the portion of the lease that has to do with the right to use the leased asset. The other kind of payments that are not included as a part of a lease obligation or the value of a leased asset are contingent rentals. Some leases include payments that vary with sales or with other future events. These payments aren't included because they haven't occurred yet. Contingent rentals are convenient because they can match rent expense with when the lessee has cash available. So if you think about renting a retail store in a mall, most of the purchases may take place in that November-December time period. And contingent rentals are a way of having a base rent and then allowing a percentage of sales to be charged for the rent in those busy months. This enables a mall to keep their tenants in place in the summer when sales are low, when the contingent rentals are going to be much smaller. A bargain purchase is a term that we've already talked about, a lease clause that establishes a purchase price at the end of the lease below market values. An alternative to a bargain purchase is a guaranteed residual value. Sometimes at the end of the lease, the asset is returned back to the lessor, and the lessor requires the asset to be returned with a particular value, or the lessee has to make up the difference with cash. that guaranteed residual value adds to the obligation of the lessee. Then we're going to talk about interest rates associated with leases. There are two potential interest rates that can be used to find the present value of future lease payments that serve as the value of the asset and the value of the lease obligation. One is the lessor's implicit interest rate. This is the interest rate that the lessor used to determine what the lease payments are. It's the lessor's required rate of return. That rate may or may not be equal to the lessee's incremental borrowing rate. That incremental borrowing rate is the rate at which the lessee could borrow money from a bank given all of its other debt obligations. A lessee has a potential, perhaps, to get a bargain rate if he has a relatively high incremental borrowing rate, but the lessor's implicit interest rate is actually lower. We looked at the criteria to separate operating leases and capital leases previously when we were discussing operating leases. Let's talk about them now from the point of view of a capital lease. There are 4 criteria that each one of which can be used to determine whether a lease is a capital lease or not. Only one of them needs to be met in order to define a lease as a capital lease. The first one, if a lease includes a transfer of title at the end of the lease term, then it will always be a capital lease. If a lease includes a bargain purchase, then it's always a capital lease. If the lease term is for 75% of the economic life of the asset or more, then it's going to be a capital lease. Or if the present value of the minimum lease payments are 90% or more of the fair value of the asset, then it's a capital lease. If all 4 of those are absent, then it's an operating lease. Only one of these needs to be present to determine a capital lease. There are exceptions to the criteria because assets that are leased to different parties throughout their lives may end up accidentally qualifying as a capital lease during those last few years in the life of their lease because they're going to be leased for more than 75% of the economic life if this is the last year in which they're being leased. So the criteria of a capital lease only apply to the beginning of the life of a lease. If an asset's remaining useful life at initiation of the lease is 25% or less of its original economic life, then the lease criteria exclude the criteria based on lease term and fair market value and will only use the title transfer and bargain purchase criteria to separate operating and capital leases. Let's look at each of these criteria more closely. A title transfer is a clause in a lease contract that gives the ownership of the leased asset to the lessee at the end of the lease contract with no additional payments. All leases with title transfers are capital leases because the lessee has in effect all of the rights and responsibilities of ownership and will have possession of that asset for its entire useful life. Let's look now a little deeper at what a bargain purchase is. A bargain purchase is a clause in a lease contract that gives the option of ownership of the leased asset to the lessee at the end of the lease contract with a payment that's clearly below market value. All leases with a bargain purchase are capital leases. And the reasoning here is that it's always in the economic interest of the lessee to pay the bargain purchase amount and become a legal owner. This is true even if the lessee doesn't want to retain the asset because the lessee could always pay the bargain price and then turn around and sell it for fair value and and have a profitable return. So bargain purchases are assumed to always be acted upon by the lessee, and thus they determine explicitly an ownership. Now let's think about evaluating a lease term to see if it's more than 75% of the useful life of an asset. The lease term is the sum of all of the non-cancelable periods of a lease plus any periods of renewal at bargain rates. If the lessee has an opportunity to renew at market lease rates, those periods are considered cancelable because the lessee has no obligation to continue the lease. The lessee could just as easily rent another asset and be no better off and no worse off. All leases of assets that have non-cancelable terms longer than 75% of their economic lives are capital leases because using an asset for most of its life is like owning it. Note that 75% level is just an ad hoc figure in GAAP and could reasonably be another level to define most, but the current rules are 75%. Here are examples of different lease terms. If in lease 1, if it's a 5-year non-cancelable lease and there's an opportunity to renew for 5 more years at market interest rates, then the lease term is 5, just the original non-cancelable period. If the economic life of this lease is 12 years, then the lease term as a percentage of economic life is 42%, and it does not meet the criteria to be a capital lease. Let's look at lease 2. If we have a lease that is 5 years non-cancelable and then can be extended for 5 more years at bargain rates, that is a total lease term of 10 years because we assume that the lessee will take advantage of any bargains. If the economic life is 12 years, then the lease term as a percentage of economic life is 83%, and it does meet the criteria to be a capital lease. Lease 3. If we have a lease that has 5 years, but the lessee can cancel at the end of any year, and there are no particular renewal options, this is a description of a 1-year lease term. That's the only obligation that there is. If the economic life were 10 years, then the lease term as a percentage of economic life would be just 10%, and it certainly would not be a capital lease based on this criteria. Let's look a little more deeply at the criteria about minimum lease payments. Minimum lease payments are the cash outflows that the lessee is obligated to pay. They're going to include the following items: the present value of the minimum lease payments excluding executory costs or contingent rentals. Remember we said that things like including payments for maintenance or landscaping or insurance, those kind of things are just operating costs. So we want to make sure that they are not included when we measure minimum lease payments. And we don't include rentals that include a portion of sales during a particular period or other items that have not occurred yet. It will include any of those items that are going to happen at the end of a lease term. So if there's a bargain purchase or a guaranteed residual value at the end of a lease, we assume that the lessee is going to have to pay each of those, and so that's an additional obligation that increases the minimum lease payments. When we've added all of those together, we're going to discount the lease payments using the smaller of the lessor's implicit interest rate. Remember we said that that was the rate of return that the lessor requires, or the lessee's incremental borrowing rate, which is the rate at which the lessee can borrow money. It includes the words if known here because lease contracts may not say exactly what the interest rate is that is being used to create the lease payments. The reason that the smaller interest rate is used, we've got to think back to time value of money. If we have a smaller discount rate, then we're going to have a larger present value. So this is a mechanism to make sure that we don't understate the value of the asset and the value of the lease obligation. For all leases of assets with minimum lease payments greater than 90% of their fair values, They're capital leases because using most of the value of an asset is like owning it. Note that the 90% level in this criteria is an ad hoc figure in GAAP and could reasonably be another level to define most, but the current rules are 90%. Examples of minimum lease payments are, let's take a look at an example of a minimum lease payment. A capital lease requires 3 payments of $33,000 paid at the beginning of each year. The payments include $1,000 to pay for taxes on the equipment, which are executory costs. At the end of the lease term, the lessee has the opportunity to purchase the equipment for $2,000, which would be below the fair value of the equipment at the end of the lease. That's a bargain purchase. The lessor used a 14% rate of return to determine the payments, but the lessee has an incremental borrowing rate of 12%. What is the value of minimum lease payments? Think about this. What are you going to use for the interest rate, and what are you going to use for the amount of payments, given all of the facts that we have here? You may want to pause this video while you work it out and then compare it to what I have. The minimum lease payments are $32,000 per year, the $33,000 minus the $1,000 that's executory costs. The discount rate is the smaller of 14% or 12%, which would be the 12%. We'll find the present value using an annuity due for the payment amount of $32,000. There's 3 payments. There's a future value of $2,000 because we have a bargain purchase involved and an interest rate of 12%. We'll sum together the present value of an annuity due of $32,000 for 3 periods at 12%, plus the present value of a future sum of $2,000 for 3 periods at 12%. You could do this using the formulas. You could look up 2 time value of money factors in a table. You can do it on a financial calculator using all of the buttons in the time value of money row, or you could use the PV, present value function, on a spreadsheet, and the value I get is $86,082. As a summary of the way the classifications impact capital leases, only one of the 4 basic criteria need to be met for a lease to be classified as a capital lease. The easiest way to go through these criteria is to start with the ones that use the least analysis. If there's a title transfer or a bargain purchase, you know immediately it's a capital lease without having to do any calculations. Next, test the lease term, including only the non-cancelable periods of the lease. And then finally, if that doesn't classify something as a capital lease, then we'll need to find the present value of the minimum lease payments, leaving out executory costs and contingent rentals, and adding in any bargain purchase or guaranteed residual value. We're going to pause here, having done about half of this objective. I'll let you read through and make sure you're clear on classifying capital versus operating leases, and then we'll pick up with the next slide in doing the financial reporting for assets that are acquired under a capital lease. Thank you.